Welcome to the Master Your Millions podcast, the show all about your financial potential and leaving a legacy for future generations. Here are your hosts, Jason and Scott Henderson.
Hello, everyone. Welcome back. I am your host, Scott Henderson, and my co-host is Dr. J. We are experienced investors and have a huge advantage where we can draw upon the wealth of multiple generations and experience in investing. Here today on Master Your Millions, we are super excited for our guest, Dr. J. Tell us who we have coming on.
Okay, I will. Sort of a long-term friend is Shannon Robnett, and Shannon Robnett is the president and CEO of Shannon Robnett Internet Industries, headquartered in the Treasure Valley of southwestern Idaho. For those of you that don't know, that's Boise. SRI is a parent company of My Vertical Equity, Phoenix Commercial Construction and Executive Management Services, Property Management. As I said, Shannon is a native of Boise, Idaho, and a fifth-generation real estate investor. For more than 30 years, Shannon has had hands-on construction experience. I'm assuming that's everywhere from actually doing the work with your hands to more of the investment side. He'll tell us more about that. Rob also has a podcast called Robnett's Real Estate Rundown. We'll have a link to that in our show notes down below. One of the reasons we invited Shannon on the podcast is to talk about an area he is very passionate about and very active, actually, and that is opportunity zones. Welcome to the podcast, Shannon.
Hey, thanks, Jason. I appreciate you inviting me on, man.
It's an honor. It's our privilege to have you here. So tell me a little bit, this fifth generation real estate investor. Tell me how that plays out.
You know, technically, I'm a fourth generation. My son is a fifth generation, but my great grandfather was selling real estate before the Great Depression, and I don't think he caused it. I think we're pretty clear on the fact that it wasn't him, right? But then my grandmother was in real estate sales, and my mother was in real estate sales. My father was a builder, and it's just always been a family business. And you're right. I mean, I used to have to go to the job sites when I was 8, 9 years old, pick up nails, scrap out, lay saw, do all those kinds of things. I grew up in the industry. I've never really had a job. I had a couple of jobs in high school, but I've never worked for anybody else in my adult years. And I've always just been involved in real estate, mostly in construction and development. And I've just found that that's been a very satisfying career. And it's a very tax advantaged career, which has allowed me to have the kind of life that I've wanted without having to carve off 35% every year to send to that big, fat, ugly uncle we all have.
Oh, no kidding. I understand that JOB is simply an acronym that stands for just over broke. So it's good you've never had one.
Yeah.
The other
thing that they say is that a job is something that somebody's agreed to pay you just enough to get you to give up on your dreams.
Yeah, I like that. And that's exactly opposite of what we're all about here on Master Your Millions, where we want to talk to people that are being successful, that are creating millions, that also are keeping those millions and enjoying them, and also have strategies to pass those on to the next generation. You mentioned your son's in it. Is he in the business with you then, I take it?
Yeah, he was in real estate with me, did a lot of entitlement work and did a lot of my due diligence. He and his wife recently moved to the Salt Lake area, so they're kind of down in your neck of the woods now. But they moved down there after they got married, and he's still in real estate, just in a different area. But it's definitely a family tradition, and he's doing very well with that.
Love it. Learn from the best, I take it. That's good that it goes from generation to generation. You tell me how you got into more on the construction side. I mean, you have a construction company. You'll go and buy raw land and build commercial rental space, right? Income properties. Is that, describe to that for me?
Well, so my dad, I watched my dad retire at 50 with cash flow. Right. And that was really kind of a foreign concept. In fact, when everybody was raving about that little purple book, Rich Dad, Poor Dad, I read it. I didn't quite get it. It didn't seem groundbreaking and just world changing to me because it was exactly the way I grew up, right? And so I watched my dad and my mom get all of their money into things that made them money every week, every month, whether they went to work or not. And I watched myself go take down a contract to build a school or a bank or retail facility. And at the end of that contract, nobody paid me after I left. I never got residual payments, but the person that I worked for did. And so I really began to hone in on that, and I began to look at that. And the other thing that my parents always complained about was taxes. Always complained about taxes. We got to pay taxes on this. How do we do that? And so I really became a student of how to create income that pays you every month and how to do it in a way that you don't pay a lot of taxes. And so I've always been a student of those two things. And I built my first industrial building that was my investment at 32 years old. And I've just been creating and accumulating passive income from that point. And in the last 3 years, we've just simply fired our clients where we are no longer a for-hire general contractor. We just simply build our own products.
And then hold on to them, I take it.
Right. Yeah, we do that for our investors and for ourselves. But, there's a long-term play, there's a short-term play, and there's a lot of tax advantages to doing it. You just need to make sure that you understand that every deal that you're doing, tax should be one of the very first things that you talk about, not the very last things that you talk about, because structure has almost everything to do with how you're taxed, right? And how you get into the deal is how you get out of the deal, and having that situation set up prior to is always very, very important. And so with doing those things, I've been able to change a lifestyle from one of looking for more clients, looking for more work to do, to looking for additional opportunities to create passive income that for the next umpteen years will continue to pay us for the work that we did today.
I love that. And for those of you that may be new to the podcast, Shannon said a minute ago that he became a student to pay the least amount of taxes. Now, he wasn't going through it and figuring out a way to cheat the system. The system, 80,000+ pages, is a roadmap that the government wants us to follow, that when we follow the roadmap, we pay a lot less taxes. So what he's been a student of is learning the proper way to go about it, so he pays the least amount of taxes. One thing that I don't even know how old it is, Rob, Shannon, maybe you can help me. How old are opportunity zones, the whole concept of opportunity zones?
Opportunity zones were, that was something that came about in the Trump administration. And one of the things, kind of to back up one step a little bit further, there's been 1031s for since the mid 80s, right? So I remember my parents talking about 1031s at the dinner table about this magic thing that allows you to sell a property that you have. Let's say you bought it for $100,000. It's now worth $300,000. And it's a rental property, and you're able to sell that property and buy another property, but you have to spend $1 more than you sold for. And it's kind of an all or nothing thing. You can't take parts of it and move parts of it up, but then you're able to continue to parlay that. The government knows that at some point you are going to sell that asset and they're going to get their taxes. But what they've agreed to do in the 1031 is allow you to continue to parlay that, knowing that at some point their gain is going to be larger and they're going to be patient. But what Trump said is there was literally trillions of dollars sitting on the sidelines waiting for tomorrow. They were playing the game, and there was lots of areas that needed additional renovations and areas that people would invest in if there was an incentive for it. And so during that administration, they came in and they said, hey, we're going to do this based on the census of where the money is in the city, and the lowest income area of the city is going to get the designation of an opportunity zone. And that opportunity zone is going to allow them to invest in here in a tax advantaged way. And it's going to help that part of the city And so they created over 2,000 census tracts across the United States that became opportunity zones based on the per capita income during that administration.
Cool. So I'm going to walk people through this. Let's say you bought a property for $500,000. It doubles in value and you go to sell it at $1 million. So that means your gain is $500,000. You take that gain at that point. Right now, you're gonna give up about $100,000. And then maybe you'd only have 400,000 to go to the next property. I mean, I'm talking capital gains,
Yep.
Federal and state, depending on where you are.
Correct.
A 1031 would allow you to go and buy another building that's say $1,001 or whatever, above $1 million. You don't pay any of those capital gains. Now, what's really cool about these opportunity zones, they are in most cities in the country. I mean, 2,000 is a lot. And it's the lower income or places of the city that's kind of run down. It's kind of older. It hasn't been kept as well. And there's an incentive that you go in there, you can do your 1031 into this. Of course, you're not going to pay your capital gains, and you build a nice new office building or a new apartment complex or something. Then what happens, Shannon, as you go on after that?
Well, the great news about that is, so, in a 1031, you had to spend that $1 million plus $1, right? If you wanted to go into an opportunity zone, there's a couple of differences. So 1031s were like-kind exchanges. Here's a funny little tip. The number one 1031 item in the state of Idaho is cattle.
Really?
So you buy the milk cow, you raise the milk cow, you offset the gain, Now the cow has produced everything it's going to produce, and you slaughter that cow, but you buy 2 new calves, right? So you've done a like-kind exchange. You can sell a business and buy another business, but you can't sell a business and buy real estate. You can't sell a cow and buy real estate. In an opportunity zone, you're allowed to do all capital gains. You can sell stock. You could sell crypto, you could sell houses, you could sell businesses, you could sell whatever you wanted to, and you could combine that into an opportunity zone deal. And you only have to invest the capital gain. So in your scenario, you bought it for $500,000, it's now worth $1 million. You could invest $100,000 up to $500,000 of only your capital gain, put your original investment back in your pocket. The beauty is the taxes are due on that $500,000 in 2026. So when this came out 4 years ago, you had an 8-year runway. We still have a 4-year runway for you to pay your capital gains. But you have 4 years to make money on it, even from today, before you have to pay your capital gain. So if you were to get a 4% return on your capital, you would create 16% on your $500,000, which would essentially offset your taxes that are due. Now, that's only half the benefit of what you're getting here, because the other half is if you leave that investment in an opportunity zone for 10 years, when you sell that product for between 2036 and 2046, you are only required, or you're not paying any capital gains on that if you held it for 10 years. So you pay your capital gains once, you bring it, you put it into an area that they're wanting to see it grow. You do that, you pay taxes 4 years down the road. So if you're doing bonus depreciation, if you're doing any of that, you should be able to create enough of a tax incentive that at the end of the day, that tax has been eliminated. You've made a little bit of money. You're paying your taxes out of your profits after the sale of the first asset. And then if you've held that for 10 years and continued that improvement opportunity, now you're paying no taxes on any of the gain. So it really was a way, and there was literally billions of dollars that flowed out of assets into opportunity zone funds and deals that created this opportunity, because everybody loves the idea of 10, 15, 20 years of growth not being taxed.
Awesome. I love that. Thanks for the explanation. So let's talk a minute. This has been kind of high level for some of the things that we do on this podcast. We interviewed a young man not so long ago, who's 15 years old, owns 47 houses. He bought his first house at 7. So one of the things I want you to now take a few minutes, Shannon, and tell us, someone who wants to start getting some passive income, where would you advise them to start? Would it be simply to contact you and say, hey, here's all my shekels that I have, go invest for me? What kind of advice would you give?
I tell you what, the first thing that anybody should do when they want to create passive income is look at their own expenses, right? Jason, if I came into your business, I said, hey, listen, give me, 3 days, I can streamline your business and I can save you 8% on your operating cost. You would rush me in the door and you would bring all your friends over to learn how to streamline and get 8% more functionality out of what you're currently doing. But if people would simply look at the tax code, they could get up to 30% of that functionality in their own life. So when you really want to start looking at investing, you need to look at how you can invest in a tax efficient way that's going to make you 30%, whether the investment makes you $1, right? And I think that a lot of people get that wrong because they look at that and they go, well, I got to buy some of this. I got to be early into this deal. If I'm not at the IPO, I'm not going to make any money. I've got to do this. I've got to do that. But if you're really looking at how do you make your money and what are you taxed on, how you efficiently eliminate that 30% tax bracket is going to make the biggest difference in your future. And I think that most people fail to look at the tax. But as Tom Wheelwright says, if you change your facts, you can in fact change your tax, right? And so when you finally decide that you want to get involved in investing, there's a lot of great opportunities out there, whether it's house hacking your first deal, whether it's getting involved in a syndication, whether it's buying oil and gas. There's a lot of things out there that will help you eliminate your taxes owed, right? And then there's the products that you have, and you and I have talked about this at length. There's ways that by investing in your future, you allow yourself to borrow and help your future by doing tax efficient things now that are going to pay off big then, right? And so it all has to do with, in my opinion, the number one strategy is to be tax efficient and tax forward in your thinking, because at that point, you've now maximized your returns and how you're planning to make your investments all through your future that are going to save you and make you additional funds that are going to allow you to invest more.
But that big uncle that you talked about, scary.
He's ugly too, man. Lazy, I mean, gee whiz, he shows up once a year, right? Like he's freaking Santa Claus, takes a third of your crap and leaves.
Not to mention the book that he writes every single year is confusing.
Oh.
So for a lot of people, like tens of thousands of pages of tax code is a little bit unreasonable to go read through. So how would you suggest that a new beginner goes and learns some of those things? Would you just go to an accountant? Would you go to an attorney? How do you go about that?
So this is the thing that a lot of people look at, I think there's a lot of misconceptions. In fact, even my accountant loves to tell me, I'm not here to help you plan your life. I'm here to account for your life, right? It's a very different thought process. But one of the things that I have found is that by being a student of the tax code, you can get very confused. But there are a couple good guys out there. Tom Wheelwright is one. He's written a couple of books that are incredible about demystifying the tax code. But he also works with a group of people, and I happen to have a tax advisor. And I would tell people that if you're looking for how to make efficient use of the tax breaks, there's several resources out there. If you want to reach out, I can plug you in with a couple. But don't rely on your accountant to take you through all the tax advantages, typically because people are going to go see their accountant in February. The cake's already baked. All we're doing is frosting it, right? Everything is already done. December 31st was the last day of the year that you can make any changes as to what taxes you're going to pay in 2023 for 2022. But if like I meet with my tax advisor in February, June, and in November. And I meet with them 3 times a year, and I plan. In February, we're planning, this is the kind of year we think we're going to have. This is what we think we're going to do. In June, how's it going? What are we doing? And in November, we make any final adjustments, and I get to go on any final shopping sprees to get any real quick depreciation, kind of like Christmas, before we end out, right? But if you're not planning that way, you are not smart enough to get through 900 pages or 90,000 pages of tax crap, figure it out, implement it, educate your accountant, and get it done. Number 2, you can hire somebody that has specialized in that stuff, right? And you can hire them while you go do what doesn't make your brain explode, right? I mean, the easiest way to have an aneurysm is go read the tax code.
You keep saying your tax advisor. Now, your tax advisor, I'm assuming, is an accountant. And what most people don't realize is a CPA is simply a general practitioner, right? We're not going to go to the family doc to have brain surgery. I mean, that makes sense to people. No, we're not going to the family doctor, the general practitioner, to have brain surgery. It's the same thing in accounting. A CPA is simply a general practitioner. You've got to find someone who's a tax advisor who has spent a lot of time studying the tax code, and they're all about tax and not only accounting, counting beans and, what's income and outgo flow and all those kinds of things. That's such a great thing. Go ahead.
And the reality is, just like you said, I mean, if you're not using a specialist in almost every line of work that you're dealing with, then you're not getting the best, right? I mean, if you're trying to find a one size fits all, that's difficult. When you're talking about these kinds of things, you need to be dealing with the specialist because, and you need to be pre-planning, like we talked about. If you're going into this entity as Jason and Scott Henderson, and you're going into this deal as those 2 guys, it always has to be you 2. But if you put it into an LLC, and now it's J&S Henderson LLC, number 1, you bought some protection, but number 2, you bought the ability to sell the LLC and have that thing go on while you exit. You've just created more optionality and functionality that you didn't used to have. And you wouldn't know that if you were going to the general practitioner, right? So you need to be using these consultants, and you need to be talking with the right people, just like you would be if you were, doing something in your own business. I mean, I don't do all the structural calculations on my buildings. I hire a specialist for that, right? Do the same thing with your taxes. Do the same thing with your LLC work, with your entity structures and trusts and how all that stuff goes together. Because you can read a book on it to get a general understanding, but you really need to be using the specialists.
I love this, and the fact that you have come into an area that we emphasize a lot on our podcast, and that's all about that when you're going to have millions, when you're going to create millions, when you're going to maintain millions and enjoy millions and pass those millions on to others, you need a team. We say that always at the end, that mastering your millions all starts with your mind and your team, and make sure they're the best.
Yeah.
You don't hire the cheapest guy on the block,
right,
to do whatever it is. You hire good help to make sure that things are happening. And you've come right into this, Shannon. I mean, it's for the fact you live it, and I love that. How have you gone about? Tell us. Well, I'm going to back up here. Let's tell us some point of failure. I know you haven't had a life of complete success. Tell us about one time when you failed, skinned your knee, and bloodied your face or something, and what you learned from that.
Well, and I'll tie the 2 together because you're right. I've had a lot of failures, and anybody that has been successful has to have them, because none of us learn in the perfect scenario in the classroom and go out and execute. But just like you talked about, I believe, Jason, that everybody that winds up as a millionaire knows that early on. They plan for that. Their mindset says they're going to be that. They set up, they work. They don't just accidentally look at it and go, "Oh, wow, look at this. I finally made millions of dollars." And one of the things that I did early on was I said, you know what? I can be my own lawyer. because I understand enough of this. I can set this up. I don't need to do these things because I just don't want to spend the money on legal fees. I don't want to spend the money on that. And just like having a tax specialist, I needed a legal specialist, and I didn't have my structure set up. And when I came to my taxes, my structures didn't line up. And so I had everything right. I executed perfectly. Everything was done, but the entities were the reasons that I couldn't do it, because I did not properly track that through, and I didn't know what I didn't know. And I thought, well, you know what? I'm going to wait till I make a lot of money to bring on the legal team. When you really need the legal team as you're doing everything so that you're set up properly, so that when your accountant's looking at it, she or he is going, yes, this works, yes, this works, yes, this works. And they're talking to each other simultaneously, because what you're giving up in money that you're paying them, you're buying in accountability, in credibility, in perfect product as far as how entities are set up, because that entity structure is so important. And there's so many different entities that you could do, and there's so many different ways that you could structure it, that if you're trying to do it yourself, you're only giving yourself probably a 30-degree window on a 360-degree view, because you know what you think you want, but you don't have the business experience that they have or the expertise that they have that give you that surround sound view. So early on, I tried to be my own lawyer. I tried to do my own thing. I used Rocket Lawyer and stuff like that to try and set up my stuff. And it wound up costing me literally hundreds of thousands of dollars in taxes later on.
Wow. I love it.
No, I didn't love it. I didn't love any part of it. You know?
Yeah, I'm sure it hasn't. Give us a little insight. I know that you've had a pretty good lifestyle, and you currently do have a good lifestyle. You're like you said, our podcast is all making the millions and then enjoying the millions. What's some of the things that you're able to do now that buddies from college and even high school are unable to do?
Well, I'm recording this podcast from Puerto Rico. Right. So I'm sitting here in Puerto Rico because I pay 4% income tax on everything I make. So I can not worry about whether my entities are set up or whatever. I can bring that income through here, pay 4%. I pay no federal income tax. Right. Another thing that I do is I've figured out how to find the things that I like, turn them into a business so that I can write them off. My wife absolutely hates it, right? But
Give us an example there. I love this. Go ahead.
I just bought my 5th airplane. I just bought a twin engine Diamond airplane, and I took that airplane. It was $400,000. I bought the airplane. I put 20% down, so I put $80,000 down, right? I also, because I love to fly, I created a flight club, and we have, I think I have 5 instructors. We have about 35 students, and I put that airplane into service. Now that airplane becomes a tool. That tool is entitled to 100% depreciation in year 1. So I wrote off the whole $400,000 airplane, Jason. Wow. That means that Uncle Sam is sending me back a check for 120 grand. I put $80,000 down. I got $120,000 back day 1 because I used my tax account that I'd set my money aside for. I took my down payment out of there because I knew I wasn't going to pay the IRS. I put it down on the airplane. I wrote off the airplane. That plane is now making me about $3,000 a month in profit, as it should, right? That should make me 8 to 10% a year. So it's making me 10% a year. I write it off. I fly a beautiful airplane whenever I want to when I get home. And I have the ability to create a $40,000 windfall, a 20% windfall, 30% windfall to me on something I love. Do that with exotic vehicles. Do that with, I mean, there are so many things that you can do that with if you understand that creating a lifestyle that pays attention to tax efficient ways to do things. I have a friend, he loves racehorses, loves them. I don't know how you make money on racehorses. He depreciates everything through racehorses because you can depreciate a racehorse. They have a short career.
Yeah, it's an asset. Yeah,
you know?
That's awesome.
So I need to know how you did this with the plane. Because
Well, you
I've
just
got a
need
little
to-
brother who has almost got his pilot's license and has been clamoring at the bit about this for a long time.
Yeah. Well, the reality is I created a business that teaches other people and rents out aircraft, right? And that becomes a tool of the business. So you buy the airplane, that's now a tool of the business, like a sledgehammer or like a tow truck would be, or whatever else you want to have, a computer, right? So now I have an airplane that I love to fly. I got 5 of them now. And I have what I want, but every year I get 1 or 2 more. I got 2 this last year. My wife was thrilled about it, trust me, because she can't, she likes things like, pictures and grand pianos and things like that. We haven't quite figured out how to write those off, but now you take that tool, you write that tool off, right? So you're taking that depreciation against your taxes. So what needs to probably happen is if your little brother's got the income, great. If not, maybe you two need to go buy the airplane and lease it back to that flight club that somebody's using, right? And then it becomes that business that makes great money and provides you with fun things to do.
I love it. So I'm going to throw you a complete curve here and go change the subject completely and ask you a question. On a scale from 1 to 10, what would you say your understanding of the infinite banking concept is?
Probably about a 6.
And why do you say that?
Because I do use it, but I'm not in the professional realm like you guys are, where I know all the nuances and the ins and outs of it. But I do know that it is beneficial, and I do know that it is a great way for people to create something that, just like my example of the airplane's paying me back 2 different ways. Infinite banking allows me to do the same thing, right? There's tax savings involved. I can let the money continue to grow while I borrow the money out and put it in I essentially can use, get 2 assets going at the same time that are both growing for me. I mean, there's just a lot of things there, but I don't have your level of expertise. Let's just be clear on that.
No, that's fine. I just want to know.
Yeah.
I know that you know a little bit about it, and wanted to let our listeners know that is something we talk to people quite often about, and especially coming now full circle back to real estate or even the airplane. When it's all in how you finance things, right? And
Right.
This is an opportunity to finance in one of the most tax advantage ways possible, is using that concept and those types of structures. Same kind of thing. I mean, my brother, I have an older
Here's
brother.
a twist I put on the infinite banking. So every project that we do with our investors is buy into my insurance policy. Okay, so I personally have an infinite banking policy, and I overfund that. And every time that we do another project, my investors put in $50,000 into my infinite banking out of the cost of the project. The profits that would have gone out, they go into there. And if in the event something happens to me, my project gets a $2 million chunk of my life insurance, right? So here I am, pre-tax, everything coming in, and I'm not even paying for my infinite banking policy. The project is. It's coming out before there's ever profits allocated, because the protection is afforded to the project if something happens to me. So just like you would buy an insurance, you always buy your insurance before the event happens. So we're buying the insurance for the project. We're just using my infinite banking policy. So they're putting money into my policy. And if and when something happens to me, great. If the project is successful, it's done, and we sell, great. It was a term policy for the project.
So why aren't you making it permanent, so it's building up cash and something that becomes
It is
residual
for me. It is for me, not for the asset.
Well, when you do term, you're not having passive income come from that.
No. You're forget. So the project uses it like term policy.
Oh, okay.
Right.
Okay.
So they buy, during the course of the project, one lump sum payment. They buy insurance on me for the project. For the life of that project, they bought a piece of my insurance policy. That goes into mine. Now I'm letting it build up. I'm using that money for me, but the project and my investors paid for that, and they got the security of knowing that if something happens to me, We got a couple $1,000,000 to fix the problems, hire somebody else, do whatever we need to make sure that that project gets finished and survives if I don't. Now, if I do, which I totally plan on doing, by the way, I don't really like the idea of anybody getting my insurance money because that means I didn't get any of it, right? I mean, so my whole thing is I want to make it through that. I want that to be a term policy for that asset, but it came to me pre-tax because it was done in exchange through my trust, right? So now it comes through and it says, hey, we're buying a piece of that for the term of this investment.
Right. So when you're, I don't know, for lack of a better term, maybe in a PPM or some sort of offering that you're giving to people, you're demonstrating that there is a safety net or a level of security, right?
Absolutely.
Right? That they're not going to lose their money when they invest with SRI.
Right.
Am I understanding you correctly?
Right. So if I get hit by a bus or say the wrong thing to my wife, at the wrong time, and I'm all of a sudden not around, there are funds to complete the project and finish the project with others other than myself and the companies that I've created. Because as we know, a lot of times when you lose the leadership of the company, it kind of gets set adrift, right? So there's a whole different thing that starts to happen. But again, it's about how you structure those things. So now somebody else is funding my infinite banking system. I'm not even the one that's having to fund it.
So in a sense, you do one deal a year, you could have your premium every year taken care of by that deal and have that in the event that it's built. So it's increasing in value, both cash value and death benefit. You would have it going. And then maybe every other year, 3 years in, the lien, if you will, or is released on that death benefit by that project that's matured and paid out and investors have got their money back and now cash flowing.
Yeah, but let's take and make it simple. Let's say that you started a business renting out exotic cars on Turo. Okay, go buy yourself a Lamborghini, right? Scott, this is great sound advice. You're, the women in your life love the fact that some guy told you to go buy a Lamborghini and write it off, right? But you write off the Lamborghini, $300,000 purchase. You write off the Lamborghini, and that business is going to rent that Lamborghini for $1,000 a day, and you're going to rent it 8 days a month. That business is going to anticipate to make $20,000 this year. But Scott, you want to make sure that you provide security and protection for your business. And so you charge that business $30,000 to buy into your infinite banking policy. You just took the profits you're going to make, stripped them out of your company, put them in as a premium on a product that they got. And now you've eliminated the taxes you were going to pay on the premium. And now if something happens in that car, something happens because you're driving at 190 miles an hour, or something happens to that business, somebody else does something in the business, you've got protection, you've got policy, right? So there's a lot of ways to set those up that you do the things that are necessary to make sure that you're not paying money and creating protection for yourself and your family. It's really a beautiful thing.
It is. That's really cool. So you're saying the business needs to charge an additional whatever on the rental or whatever, that the business needs to buy a policy on the owner of the business to make sure, like a key man almost type of thing.
Yeah, exactly.
And that's doing it. Who actually owns the policy in your scenario? You or the business?
You own. So they buy a piece of my policy, right? So I have a trust. My insurance is kept in the trust, and they buy a piece of that policy. So if something happens to me, XYZ exotic car business gets a piece of that because it may not survive, right? And now there's car payments, there's other things that happen. But what it really did was it stripped the profits out of XYZ exotic car company and put them into my policy where I get to use them personally after tax, right? I'm not taxed on what's in my policy because it was put in as a business expense. So now the $30,000 profit that this company was going to have, it bought key man insurance that went over here that I'm able to use the $30,000 to buy real estate with, or whatever else I'd like to buy, right? And we were able to avoid the tax in that situation because it was an expense.
Great advice. From beginning to end, Shannon's been all about saying, look, you got to be careful about what's happening with your taxes in your life. I love it. It's been really good. Scott, do you have any questions?
I've got plenty of questions. I guess staying on the subject real quick, do you just go create the business yourself? Do you go partner with someone? Let's go back to the exotic car example. Let's say you go buy a Lamborghini. Do you go find someone that's already doing Turo and say, hey, look, like, how about I give you 10 days a month that you can rent this thing out? I just want a certain amount back.
The problem with that, Scott, is I want the $300,000 write-off.
Right.
I want the tool. I want take the Lamborghini from a car that doesn't qualify. It's not 6,000 pounds. It's not any of those things. But if it's an asset in a Turo business, then I get that benefit. I'm going to finance that, right? And I'm going to then put it on Turo, and those people are going to pay me, right? And look, I just used this. My son and I went to Scottsdale for his 21st birthday, and we rented a Ferrari 488, right? It was a beautiful car, and the guy had 9. He had 9 cars that he rented out about 8 or 9 days a month and was collecting money on every single one of them. But he was really doing it for the underlying value that the tax return had. So you buy a $300,000 car, you write it off, you save yourself a check that you were going to send to the IRS for $100,000. Now all you're trying to do is have Turo pay the bill on the tax advantage you already created and took yourself. Now, if that's continuing, if each car is making you $10,000 or $15,000 a year, that's then going into a life insurance policy that's building up cash value for you, all of this is done in a fashion that is all about the tax savings and how you do it without giving any of that to Uncle Sam at any point.
I gotcha. I guess my question was more coming from like a time perspective, because it's getting to the point where that's more important than having so many operating businesses.
I'll meet you at the Lamborghini dealership. You and me, we'll go partners on it. You know,
I'm done.
We just gotta agree on
when? Come
You know?
up here. It's way cold up here. You're not going to survive 10 minutes.
I know. I saw that it snowed 3 inches in Boise, and I'm down here in my shorts. So,
well, good. So I know that we've had quite a bit of your time, and we could talk all day because I have all kinds of questions, but kind of last one is, you got 5 years into the future. What are we to expect from you, or what is it that you're looking forward to and building over the next 5 years?
You know, I have no intention of ever retiring. I think, the last day in business is going to be right before they close the lid on the coffin, because I love what I do. I love solving problems. I love creating cash flow. I love giving back to the communities I live and work in. And so for me, I'm going to continue to do everything that I'm doing now. I think that we're going to see things are returning to a norm that I'm used to in real estate. I think we're going to see, in the last 5 years, we've raised about $50 million in syndicated capital, and we've grown a portfolio. I think in the next 5 years, we're probably going to raise another 125 million in syndicated capital. Our portfolio size will probably triple in the next 5 years. In fact, I would anticipate that the next 5 years are going to be better than the last 2 years for real estate. So I see that we're going to grow substantially. And I think that there's going to be a tremendous amount of opportunities for people and for us to build a community that builds a passive income for ourselves and a lot of other people.
Cool. Well, I know that we are looking to, for all the listeners out there, Shannon is one of the best when it comes to that. And so if any of our listeners wanted to connect with you, Shannon, how would they go about doing that?
The easiest way to do that is just send me an email to connect@shannonrobnett.com. That comes straight to my email. I'd love to respond. It gives you access to my website. It gives you my calendar. All of that stuff's right there. So if you just shoot me an email at connect@shannonrobnett.com, we'll be face-to-face in no time.
Awesome. Jason, any last words?
No, thanks again, Shannon. We really appreciate it.
Of course.
I appreciate you having me on the show.
Of course. We love it. Anyway, guys, again, remember, if you'd like to connect with us, hit us up on our Facebook group, Instagram, Twitter, or shoot us an email. All the links are in the show notes down below. Remember that mastering your millions all starts with your mind and your team. Make sure they are the best. Catch you next time.
Thanks for listening to Master Your Millions with Jason and Scott Henderson. Check the show notes for any links or contact information about today's guest. Make sure to follow the show so you don't miss any future episodes.